Howdy, friends. Corey Moser with your Mortgage and Economic Weekly Update for Friday, October 24th. So as you still know, the government shutdown is still in play, and a lot of data is not released because of that, but something was released today. That's your Consumer Price Index, CPI, which kind of gives you an idea of inflation or the cost of goods presently. And that number came in strong, but it actually is quite favorable for the bond market. So as I'm speaking today, the national average for a 30-year fixed mortgage is 6.18%, and the 10-year treasury is just below 4%. We're at 3.99%. So all good things. But the Mortgage Bankers Association released some information this week indicating that they expect mortgage rates to be in the mid 6% range for the next couple of years. So that would be until 2028. But we need some relief, obviously. There's a lot of people hoping for mortgage rates to come down. They're hoping that if they could get down to at least 5.5%, there's about 5 million people out there who would benefit from a refinance if rates could come down to 5.5%. A lot of people are still concerned about affordability of homes. And the question is, like, how do we get these home prices to come down so that they're more affordable? Well, that's less likely to occur. If you look historically at the data, home values have typically gone up. There's only been a few times in history that home values have actually gone down. More recently was during the housing crisis in 2008 to 2010. But otherwise, you're seeing home prices appreciate. And that's because there are fewer homes available than the number of people who want to buy homes. But if they're too high, obviously people can't afford to buy them. So the best way to create affordability is to lower mortgage rates. So we're expecting next week the Federal Reserve to make another 0.25% rate reduction and probably another 0.25% rate reduction in December. Now keep in mind that the Federal Reserve does not control long-term rates like mortgages. They control short-term rates. So when they make a cut, those short-term rates immediately go with it. You'll see that in car loans or in home equity loans or even your savings account. Those amounts go down when there's a rate cut. But historically, mortgage rates do generally trend to move the same direction as the Federal Reserve. And it's not immediate. Sometimes the pricing is already built in, which is what we're expecting. So mortgage rates have been coming down. But we need something to get rates down faster so that there's more affordability. And a letter was sent to the Treasury Secretary and to the FHFA director with a proposal that they start using some of their surplus, basically about $300 billion, to purchase mortgage-backed securities. If they did that, that could actually lower rates about 30 basis points, getting us a little closer to that 5.5% range. So there is some light on the horizon, potential changes to interest rates coming down. But if you're looking at the data that came out from the Mortgage Bankers Association, you may not see rates come down much, and you can expect them to be in that mid 6% range. And whether Fannie Mae or Freddie Mac decide to purchase mortgage-backed securities or not, that still is an uncertainty. If they were able to cut some of their fees, that could help drive rates lower. But if you're waiting for rates to get in those 2.5%, 2%, 3% range, don't expect that. They're not coming, and they won't. That was a time where there was quantitative easing. That's where the Federal Reserve was buying mortgage-backed securities, but they're not doing that anymore. So it's really tied to risk. It's what's happening in the Treasury. It's what's happening overall in the market that causes rates to change. Now, we've got a lot of people who are hurting. We recognize that. Auto loan delinquencies are at the highest they've been in 15 years. Credit card delinquencies, they continue to go up and are the worst they've been in a number of years. So we need some affordability. We need something that will bring these rates down. So keep in mind that things are moving in the right direction. We're a little bit lower than we were last week. We're at 6.18%. And hopefully we'll continue to move in that direction. Please reach out if you have any questions. I'd love to chat with you and help you understand some of this data. and see if potentially a refinance or buying a home might be a good thing for you. And have a great weekend, and we'll talk to you soon. Take care.